Hello and welcome. We are pleased to share this new update from White Paper Actuaries, covering an impactful and timely topic for year-end actuarial valuations of employee benefits in Kingdom of Saudi Arabia. This session will cover the background of this legislative shift and its impact on end-of-service benefit provisions and the accounting approach for recognizing these changes. Let's dive into the details. End of service benefit is a mandatory benefit in Saudi Arabia, representing the organization's appreciation for an employee's dedication. The Saudi Arabia labor law mandates that employers provide an end of service benefit to employees, both Saudi nationals and expatriates, upon termination of employment. The Saudi legislator obliges the employer to pay to worker at the end of the work contract, whether the work contract is for the fixed term or indefinite term. Regarding end of service settlement, Article 84 of the KSA labor law states that upon the end of the work relation, the employer shall pay the worker an end of service award of a half month wage for each of the first 5 years and a 1 month wage for each of the following years. The end of the service award shall be calculated on the basis of the last wage, and the worker shall be entitled to an end of service award for the portion of the year in the proportion to the time spent on the job. In KSA, an employee is entitled to an end of service benefit upon completion of 2 years of service if he is resigning from the work. In the case of termination, the employee is entitled to a full accrual if the service period is more than 1 year. Article 74 of the KSA Labour Law, published on 15 February 2023, states that employment contracts shall terminate when a worker reaches retirement age as defined by the Social Insurance Law, unless both parties agree to continue work after this age. On July 2, 2024, an amendment to the KSA Social Insurance Law was announced, which includes an increase in the statutory retirement age for Saudi nationals from 60 Hijri or 58 Gregorian to a range between 58 and 65 Gregorian, depending on the employee's age as of July 3, 2024. For new employees joining the workforce after July 2, 2024, the statutory retirement age will be set at 65 Gregorian. This extended retirement window will affect the timing of the end of service benefit provisions in future actuarial valuations, aligning expected retirement ages with the updated legislative guidance, which anticipates most employees retiring at these ages. Consequently, actuarial valuation for the end of service benefit schemes will need to account for this change. End of service scheme pays benefit as lump sum at employee exit from the organization. Exit from the organization usually occurs on resignation, termination, death, disability and retirement. Usually resignation and termination forms bulk of the exit, followed by the retirement and death. As per Saudi law, the benefit payable on retirement is at par with the exit due to resignation. The likely impact of the retirement age change will be dependent on two factors. First, the likelihood of the employee to retire from the organization. Second, the salary escalation rate assumption versus discount rate assumption. So, let's discuss these factors in detail. The impact of change in retirement age shall be dependent on how likely employees will retire from the company. For simplicity, let us assume there are only two possible ways of employee exit from the company: resignation and retirement. For an organization where the expected chance of resignation is high, the likelihood of the employee remaining active till retirement is lower. Thus, we expect the impact of the retirement age to be lower. Alternatively, if the resignation is expected to be lower, then more employees shall be in the company till retirement, thereby making the impact of the retirement age change to be higher. For KSA, we have seen resignation and termination assumption to be in the range of 10% to 20%. Thus, impact of the change in retirement age will be high on the end of service benefit for organizations with substantial proportion of employees nearing the retirement age, and for organizations with low expected future attrition rates. Hence, attrition rate, and the employee's age are expected to determine quantum of the impact. The next lever of determining quantum and the direction of the impact of change in retirement age will be the relationship of the future salary increase and the discount rate assumption. Following is the general relationship result when employee is expected to stay longer with the organization. Scheme with higher salary increase assumption than the discount rate shall see a higher obligation, while schemes with lower salary rate assumption than the discount rate shall see lower obligation. The change in the retirement age law for Saudi Arabia is likely to increase employee expected future tenure with the organization. Hence, relationship between the future salary growth rate and the discount rate will determine whether this change will increase or decrease the liability. This relationship will also influence the extent of the impact resulting from the change in retirement age. To see impact of retirement age change, we analyzed various combination of employee age, attrition rate, salary increase rate and discount rate relationship. The below illustrations consider sample employee who has worked for exactly 5 years with the company and earned 10,000 Saudi Riyal. The first chart illustrates impact for the change in retirement age from age 58 to 65 with different combination of age and attrition. Employees with age 30, 40, 50 years is computed for retirement age change with future attrition rate of 2%, 5%, 10%, 15% per annum. We can see two clear trends here. With smaller attrition rate assumption, we see a higher impact for the change in retirement age. The quantum, we see two clear trends here. With smaller attrition rate assumption, we see a higher impact for the change in retirement age. The quantum of the impact is higher for employees with their present age closer to retirement. Both these factors contribute to a higher chance of employees being active with the company at retirement. This chart considered salary increase assumption of 6% per annum and discount rate of 5% per annum for all scenarios. The second chart illustrates the quantum of impact for the change in salary rate. We use salary rate of 7%, 6%, 5%, 4% and kept attrition fixed at 10% per annum. Here are the emerging trends. When the salary rate is higher than the discount rate, the obligation increases with the change in the retirement age. The trend reverses with the salary rate lower than the discount rate. And the quantum of the impact is higher when the difference between the salary and the discount rate is also higher. We hope this analysis gives you guidance to help your organization manage your year-end financials. Once the impact of assumption change is determined, the next point of consideration will be about its accounting treatment. IFRS accounting standard IS 19 suggests that the event of past service cost arise when there is a change in benefit obligation resulting from plan amendment. A plan amendment occurs when an entity introduces, withdraws or changes benefit payable under existing plans. As seen previously, the change in retirement age is brought by the Saudi social insurance law. The change shall defer the payment of benefit should an employee decide to retire. Thus, the change in obligation should be considered as a plan amendment, thereby raising the past service cost. Thus, it will impact the current year profit and loss of the company. As seen previously, it may be possible that the impact due to this change may not be material for the end of service benefit scheme. If so, the organization can discuss with their auditors and may consider this change as an assumption change. In such case, the impact shall flow through other comprehensive income. We would be pleased to assist with any actuarial valuation needs you may have. Our solutions help organizations with several value adds along with standard accounting report. Some of these solutions are detailed gain loss analysis where we analyze and share key drivers of the liability movement in current valuation period. Understanding these factors help organization draw future strategy for assumption risk management of the scheme. Organization with multiple entities within or outside Saudi Arabia can benefit from our consolidation report. This is an Excel-based report with currency conversion feature so that results can be viewed in a single currency even though base results are in different currencies. Companies often worry about impact of changing actuaries on their scheme financials. To address this concern, we offer a complimentary transition service as a part of our valuation takeover process. We conduct a thorough replication of the previous year's work for our client. This pro bono service ensures a seamless transition and helps the company understand any potential impact resulting from changes in actuarial calculations.